Time for another review. This time we are talking at Take-Two Interactive Software, TTWO. I'm going to, over the next 10-15 minutes, present you with all the information that you need to be able to invest or make an informed decision on this stock. I'm going to show you the balance sheet, the inside trading, who's buying, who's selling, the margins, the profit, the loss, the balance sheet. Did I mention that twice? Probably. I'm going to show you a back test comparing to the S&P. We're going to look at the news, why it's up, who's buying, who's selling, the margins of the company, all of that stuff. We're going to start off very, very basic, and then we're going to get more and more detailed as we go throughout the video. I can review a stock for you. I do it for free. It's part of my membership service to my members. You can be a member from a couple of bucks a month, and there are many, many perks and benefits. This is just one of many. If you want it done straight away, give me a super chat and I'll do it instantly for you. So let's get straight into it. We use the most advanced technological and analytic software available today, and we use that information as well as fundamental, and I build relationships with the CEOs and the companies themselves to get a full rounded perspective of the stock. I have to say, I'm not a gambler, I'm an investor. This is not financial advice, but this is what I do with my money, and I'm up from $5,000 and today I think we're nearly $55,000. So I've done pretty well with this strategy, and I consistently beat the market, consistently beat Warren Buffett, above average. So I'm very happy with that. Anyway, let's go straight into it. If it's your first time here, please do click subscribe and ring the bell and give me a thumbs up as well to share the video out, and you're more likely to be notified about my content if you tap the like button. That's how it works with YouTube. All right, let's go straight into it. We're going to do some very basic research first of all, and then we're going to go into some more detail. So here's our first glimpse of our basic information. We're then going to jump into the financials, and we're going to fly through the numbers and the balance sheet like this over here. So you'll see all of that in a minute. We're also going to give you a full back test using this software as well, so we can compare to the S&P to give us some real value. We're going to look at the website as well. Very important to see the way the company present themselves to the world. All of this information you're going to get right now. So let's start from the very basics. Apologize if you know the basic stuff, but we're going to go through all of it. You can skip through if you want, deep dive instantly. So let's get straight into it. Take-Two. What is Take-Two? Interactive software. Engages in the development, publishing, and marketing of interactive software games. Its products and designs for console systems, handheld game systems, and personal computers. Okay, we get an idea of what this company's about. Strauss H. Zelnick is the CEO. It's the first thing I like to do if I'm buying it is research who he is, what his success is, what he's done, and all the rest of it. 11,580 employees, headquartered in New York, founded in 1993. Okay, straight off the bat, I will tell you this is not my kind of stock already. I'm not into buying this kind of thing, and I'll explain why later on in the video. But let's carry on. If we were buying it right now using margin, it's 25% maintenance requirement, which means it's regarded by the brokerage as quite low risk. Volatility should be pretty sound on this. Highest is 100, lowest is 25. It's at the lowest level on margin, so that's okay. 26.49 billion. It's a big cap. It's a decent sized company, and its high today is 156. It's 52-week high 156. So we're at an all-time high right now. Never a good time to buy any stock. In my opinion, I don't FOMO, I don't chase stocks, I buy when they're down and they're undervalued. Remember, I don't buy stocks, I buy companies. Price earnings ratio, 16.78. Okay, that's not good. That doesn't mean to say it's bad, but that's not a good sign when we first look at a stock. 52-week low, 96, 52, the low today is 152.30. It's not a dividend stock, it doesn't pay you any dividends. It's all about the growth. Of course, a stock like like this more than likely is going to be. What we're looking for is the S curve. As it had its S curve, is it likely to get another S curve? Another benefit? We don't know. We'll look at that in a minute. Average volume 2.79. Today's volume is just under 1 million. So the volume is low today, despite the market up so much. That's interesting. Let's move on down. Some latest news just very quickly. Take-Two Interactive Software second quarter earnings revenue beat expectations. We're not going to cover that news yet. We're going to go into some more in-depth information in a minute. I like to look at this. Again, I've got some much deeper information. This is quite up to date this time though with Morningstar. I use much better analyst software, which we'll come to in a minute. This is just the basic stuff right now. Buy 80%, hold 15%, 3% sell. The bulls say the introduction of GTA Online, Grand Theft Auto, enabled the firm to monetize the gain beyond the initial sale. The bears say Take-Two competes with firms with larger balance sheets and a higher capacity to absorb failures. That's the margin. That's the moat. That's why I straight off the bat said this is not my type of company. I go for the bigger companies because they can crush companies like this in a blink of an eye. So for me, this is not the type of company that I would invest in. I like proprietary companies that are unique, that do things that nobody else does better than everybody else and can crush the competition. So anyway, let's move on down. If we look at the fair value, again, this is not accurate. I'll give you much more in-depth information in a minute. They're saying at 165. So they're suggesting it's undervalued, but we'll go into much deeper numbers in a minute. As you can see, the company does make money, but the earnings share for what the amount it is too expensive right now. But again, we'll cover that in more detail in a moment. Analysts review this stock and they're pretty spot on with it. Pretty much, we missed here, we matched it here, we missed and missed. We've only started beating it recently in its last Q2 of 24, most recent earnings, which was estimated 104. It made 122, so it started to make money now. That's interesting because we've been missing on earnings for quite a while, and now we've beaten. I think that the last time we beat earnings looks like back here in 22. So that's encouraging. And of course, inflation coming down now, interest rates are bound to come down in the spring, the summer. People could be spending more on games. This could be a good thing. Anyway, let's see who buys the stock. Who buys the stock? Important because it tells you the sentiment of the stock, who's buying it, how it will trade. It gives you an idea, is it full of gamblers, FOMOers, pump and dumpers, whatever. Pinterest, rubbish. Don't like Pinterest. Wouldn't touch Pinterest with a barge pole. Don't like that. Fiverr, don't know much about it. Don't know much about Appian. CrowdStrike, know a bit about it, not enough. Trade Desk, okay, not too much. Disney, I'm interested in. It did improve when the CEO changed, but I'm still not an investor in Disney. What there isn't any real solid, in my opinion, any solid companies that show me discipline of investing. It looks a little bit like, not terrible. There's not a Mullen in there. There's not a real rubbish stock in there which says, okay, it's a pump and dump. But there's nothing which gives me any belief that the right kind of people are buying it on a basic level, right? Okay, let's move along and let's go and have a little look at the presentation of the company. It's important. The company website isn't just for the customer, it's for the investor. What sort of website is this? We can see who it aims at. It aims at gamers, obviously. So the website needs to be young and fresh and cool and all the rest of it. So is it young and fresh and cool? And well, you can decide. I think it's quite a basic website so far on initial look. Investors, let's have a look at the investors. It's okay. I would give this perhaps a 5 out of 10 so far. Not a great website, not a rubbish website, whatever. Let's see how it addresses the investor. Okay. Just having a basic look. You can go into more detail of this. I'm just giving you a basic look. Let's now start going into some more detail with the important stuff, the numbers, how we actually decide whether we're buying a company or not. All right, this is important. Let's go straight into it. And I'll give you the links in a minute, how you can get access to some of the software that I use, not all of it, but some of the software that I use, and you can get a discount, which will get the cheapest price anywhere. No one else, CNBC, Bloomberg, Mad Money, Jim Cramer, none of them have the discount that I have, all right? And I even have my reviews posted on this platform. That's how much they like my reviews. Okay, let's have a look and let's go deeper in. Intrinsic value, and we've got all the metrics we need here. Sometimes companies don't give us what we need, and so we can't get an accurate valuation. Here we can. Best case scenario, at a price of, if we value the company 167. Now, best case scenario, we could be moving there next year with interest rates coming down, more people buying gaming, Christmas coming up. Potentially, but that's only a 7%. Base case, 26% overvaluation. And I will tell you off the bat, for anything with great innovation, proprietary, unique, Virgin Galactic, Tesla, Apple, unique companies that only do what they do, you can buy an overvaluation of 25%. That's it, not 26. 25% because a stock can grow into its valuation. If it's really unique and proprietary, good balance sheet and everything else is great, potentially you could allow none of this 70%, 80%, 100%. We've seen it time and time again. You know, Tesla goes up too much, it comes straight back down. $2,000 a share, everybody thought it was going to go there. You wouldn't pay $10 for a can of Coke if it's only worth $1, right? Same thing. You can't pay any price for anything. So valuation, base case, it's over my 25%. Is it unique? No. We'll look at other companies. We'll come to its competition in a minute. So I'm not buying this. Already, this is a no from me. Worst case scenario. If we value the company at $80, it's still overvalued. Overvaluation 49%. Worst case scenario, overvaluation 49%. This is the right time. This was $155. This is today's price as well. I just want to make sure that we are today's price. Okay. If we look at historical profit, 96% historical profit, current valuation down 26%, price valuation correlation 36%, and the value CAGR 1%. We've seen the best times to buy the stock around about here, as we can see, June in 2020. We can see another good time to buy the stock in 22. Not now. Overpriced again. Another no, not buying it. Let's look at the fundamental analysis of the stock. Let's look at that. We're down 2% over the latest range, 5.4 billion revenue. Okay, we've been calling off, and analysts predict that we're going to go sideways for a while. They don't like the growth for a while. March 24, we're going down perhaps. September 29, December 29, expecting it to go down, maybe some growth next year. Exactly like I predicted, even before I looked at that, I said when inflation goes down and interest rates go down, people will buy more. Next year, we could have a little run at Christmas, but then we'll see those figures in January, February next year, which is when I said the rates will come down at the spring and the summer. That's when the analysts agree with me. Before I looked at it, that's what I told you, right? So potential growth in the future. Right now, it's the wrong time to buy it, in my opinion. Operating income is negative 1.1 billion. That's up 6%, as we can see. Net income is 1.5 billion negative, and that's up. That's down 23%. Okay, let's look at the balance sheet. What's the balance sheet looking like? This is where it gives us our moat, and we talk about moat and margins because a bigger company could have greater margins. They could crush the competition. Let's look at margins. So first of all, the balance sheet. 15.2 of assets, 6 5.8 billion of liabilities. That's good. Very, very happy with the amount of the amount of liabilities as opposed to the balance to the assets. Okay, let's look at the debt. Long-term debt, 2.7 billion, and accounts payable, 132 million. So as we can see that the balance sheet is okay. We haven't got liabilities approaching 95% or even more. We're okay. We're on the right side of the balance sheet. Now then, margins. I have to say I am new to this industry. This is the first time I've looked at this company today. I would assume, I might be wrong, so take this with a pinch of salt. I would assume the margins are low, 43%. I might be wrong with that because I would expect a software company to have greater margins than that. And you can now use this software if you've got it, and you can get it for free using my link. You can have a couple of stocks to review. Go and check out, I don't know, the competition. We'll come on the competition in a minute and see if you're finding 50, 60 or 80% margins, which I think you might find in this industry. I might be wrong, but my experience tells me that's potential. It does appear I was right because back in 2022, we had 60% margins. So I do think I'm right on that. I haven't looked, but just my experience of investing. 60%. So margins are getting squeezed. Competition can crush you. There are better opportunities. So that's what I'm thinking. And now we're down to 43%. All right. Operating margin down 21%. As you can see, net margin down 28%. So the efficiency of the company, the moat around the company, perhaps isn't as good as we'd like it to be. Profitability, because it does have a decent margin, not the greatest margin perhaps for the industry, but nevertheless, a margin nevertheless. Profitability score, 46%, we're going to give it. So it's got some decent profit there. Negative free cash flow though. Negative free cash flow. We're not giving that a good, we're not getting that, we're giving that a cross. We're not giving that a green tick, I'm afraid. So profitability score would be a lot higher if it wasn't for the negative cash flow. And if we go back up to that, we can see the cash flow, operating cash flow. We can see there turning red down here. In June 29th, we can see that operating cash flow is 84.5 million down. So we don't like that. It has increased from September, but back in June it was down. So anyway, cash flow isn't giving us a good score. We don't like that. Solvency. It's not going bust, like I said from the balance sheet. The balance sheet's okay. Its debts aren't out of control. It's not going bust anytime soon. However, I would like to have seen the margins increase, be better than they are. We're not red. We're not green. We're in the middle. We're okay. Solvency's okay. If you believe in it, it's got a long run. It's not going to go bankrupt in the next 12 months, 2 years, and probably way beyond that as well. Wall Street. Wall Street give this a rating here of 15% upside. It's not worth it to me. I'd buy the S&P. At best, at worst, 3%. At worst, an average 3%. At worst, 3% down. At today's price, today's valuation, Wall Street aren't giving this a very good forecast. Again, I'd rather buy the S&P or look at the competition if I particularly like this kind of industry. If we now look at the competitive landscape, Electronic Arts, there you go. I bet if we look at Electronic Arts, I wonder what their margin is. I don't normally go into another company during a review, but I will. Let's look at their margin. And there you go. I tell you what, it makes me feel really good when I'm right before I see the information. From my experience, it just means I'm getting it right more often. It means I'm learning more and more all the time. And you learn from mistakes, not from the successes. And I'm really, really pleased that I was right. I said the competition would have a greater margin, and they do. So Electronic Arts is 76%. So you can see there that you'd be far better initially looking at that. In fact, if you look at the balance sheet of Electronic Arts, it leaves it miles behind. So there is that. So it's great that I was right before I looked, right? It's good. And you need to get like that. You need to be able to review a stock at a glance of an eye, get a feel, a flavor, understand where the stock's going. So we can clearly see that this is got a threat from its competition, right? The ownership, who's buying on the inside, who's selling it. Now, looking at the ownership, we did see some selling over the last few months. Not great to see. However, we need to find out how many shares this is to their allocation. If it's 1%, it's just tax move. If it's 90%, the company are getting rid of their stocks. So we can see some. You can go into further detail if you use the software. We can see the latest transaction was made on June the 5th, a couple of months ago, by the chief legal officer, who sold $862,000 worth of the shares. However, we need to know what the percentage of that is. And I'm working to find that. I'm working to add that metric into our software. I'm speaking to the CEO of Alpha to build that in. Anyway, finally going down, we look at some latest information, if it's up to date, and it is. So what does Jim Cramer have to say about this stock?
As some of my friends at NVIDIA tell me, that there could be some things lurking inside that we never thought, kind of like...
And remember, Jim Cramer, very clever guy, knows all about stocks, but he's there for entertainment purposes, as am I, but he is selling TV. I am not selling videos, even though that's what I... looks like I do. It's not. I'm live all day, building a family, an audience. I'm trying to be known as the most honest person on YouTube TV, not dramatic headlines, not the way Jim Cramer does things. Jim Cramer is selling sensationalistic stories to get headlines and drama to sell a TV show. 9 times out of 10, Jim Cramer is wrong. He's wrong on J&J. He's wrong on many other stocks. So take this with a pinch of salt.
Free guy, where people who are non-players may turn out to be not as much non-players as you think.
Well, again, I wouldn't talk about any particular title. I do think that generative AI is going to change the nature of what we do. And
he was just slammed down there straight away from this guest. So you have to realize Jim Cramer does try to poke try to get the drama out of anything, and it's slapped straight down.
It'll change the nature of many of our games in the future, all to the good for players and consumers. I think your point, Jim, is that could indeed broaden the market, because to the extent that the experience is more compelling and more welcoming. We already have 2.5 billion people on the face of the earth who play video games. Right. Maybe that number goes up.
Okay, that's what I'm thinking, is that what will happen is that my nephew will say, Uncle Jumbo, have you seen this game? I'll say, no, of course I've seen the game. He says, no, you haven't seen. I want you this character, that. I think it's sort of word of mouth for the next iteration that can make it so big.
I think there's enormous opportunity ahead, and we are already the fastest growing industry in the entertainment business, and I think the business is likely.
No question about it. The business itself generally, not necessarily for this company, but generally is expanding. More people play games than watch the NBA, the NFL, the Super Bowl combined. No question about it. It is the future. Online gaming, without a doubt, is the future. Whether it's right to buy this company or not is a completely different thing.
To accelerate, and technology is part of that. Not all of it, but part of it.
There we go. There's that information there from Jim. It now goes on to other things which I don't want to bother with. All right, now we move down to the sentiment. Now the sentiment is important. It tells you what the shareholder thinks of the stock around the news. So if we get back over the last 90 days, positive was 70, negative was 6. Okay. Pretty much the same. Hasn't really changed. Pretty much hasn't changed. Today we got good news. So today got good news, hence why the stock is up. But we've got some negativity around there, some neutral stock, some neutral sentiment. So there we go. For me, it's not one to buy. I think there's better opportunities in this sector, but it's okay. It's got some potential upside. How does it compare to the S&P though? Like I said, if you're going to take that level of risk and pay that price, you've got to compare it to the S&P. So let's do just that. If you put $10,000 in 2010 into the 2011 into the S&P, you would have $42,000. You would have made a nice chunk of change. However, if you'd bought $10,000 of Take-Two, you would have $109,000. 10x. Done very, very well indeed. We can see the volatility here. We can see round here. This was April 30th, 2012. Massive drop here. Then it overtook the S&P and off it went. When the S&P has been going up, the Take-Two has kept on going. It's got that built-in volatility though, so don't get surprised if you can drop. So don't overpay for the stock. But has it got future growth? Yes, the industry has. Is this the right stock? I don't know. It's not one for me, I have to say. I don't think I would buy Take-Two at this valuation, but it's not going bust anytime soon. It's got good sentiment. The balance sheet is good. The margin is the one thing that concerns me. The margin and debt is the one thing that concern me with this stock. There are other companies in far better position that can crush this company. It's still regarded as a minnow compared to others. It can be crushed. There's my opinion. There is the Take-Two review. I hope that was of useful to you. Click above my head if you want all my social links, if you want my newsletter, if you want to know what I'm buying and selling stocks before I buy and sell on my X account, my website, and so on and so forth. Also, the referral link to Alpha. All my members get a 10% discount, which basically makes my membership for free. It's the best value of anyone, and you will see my reviews on Alpha at the bottom of the review. Where Jim Cramer was, it'll be above Jim Cramer in a couple of days' time when I post this video. There'll be more videos over here in the series I think you will find useful, and that's it from me. It's not a buy from me. Good luck if you're buying it. It's being trimmed off now, as you can see. Until next time, as always, take care of yourselves and each other.